Hey everyone, welcome back to another episode of AWM Insights. It's your Power 3 2 CPWAs and a CFA. We are Erik, Brandon, and Justin, and each week we cover what you need to know to capture the returns you deserve and invest like a pro. And today we're going to take a little bit of a detour of our typical structure where we're looking of what's gone on over really the past week. And we wanted to spend some time going a little bit deeper into the private markets. And we think that this is such an important conversation to have because of what we've seen over the past year of the excitement of trying to make money by individual stock picking, the entrance of new exciting conversations around cryptos and NFTs. Of one of the things we drill down on is our commitment to help you capture the highest drivers of returns. And you have heard us time and time again talking about that we believe so strongly those returns come from the private markets. And so we're going to do a deep dive today. Of course, we're not going to have enough time to cover everything in depth. So make sure you head over to awminsights.com where we're going to load up with additional resources. But with that intro, let's jump right into the conversation of what are the private markets and why is it here that the best returns show up?
Well, right. We got to first start the conversation with unpacking sources of return or sources of risk. We talked a lot about that from an equity market perspective or a public market perspective, actually. Let's say that a couple of weeks back. And what we mean there is, where do we expect our returns to come from, right? You're risking money and you expect some form of return for that. In the public markets, we think about it through risk premiums, which is the risk, the expected return over and above some benchmark rate, and where when moving to the private markets, we think about it from an engineering perspective, right? We start to get into more of a competitive advantage conversation, right? What do these individuals who are running these companies, who are making these investments in the private markets have in addition or over and above the average investor or the public markets for that matter? Add to that the confidence around that, right? Is this a space or is this a vehicle where we think the confidence in positive returns or excess returns is high, right? We can get fooled to think that, hey, just because we're participating in the private markets, we're automatically going to get a higher rate of return. Well, no, you got to really unpack what's the vehicle you're being invested in. What's the carry, which a carry is how much money the manager is taking kind of in a performance fee type structure. So there's all sorts of things to add to the basic building blocks of risk or return in the public markets, which generally start with enterprise risk or like broad market risk is the best way to think about it. We start to add all these different layers and components of risk when we're thinking about private investments. And at the end of the day, right, we want to have a high level of confidence, probably even higher than the public markets when we're making a private market investment.
Yeah, I think those are really good points, Justin. I mean, we've hit this over the head so many times, but when you start to look at the data, and this goes back, we do want to be compensated for the enterprise risk. So basically being invested in the public markets. And then we've hammered home, the competitive advantage. And there's a great paper called Luck versus Skill Luck versus Skill in the cross section of mutual funds, really enthralling title there. But by Eugene Fama and Ken French in the Journal of Finance. And what they did is they dissected the public markets, right? And basically came away with a conclusion via the evidence is that there is no real skill that can be identified. It is more attributable to luck. However, like you mentioned, when we flip over to the private side, an equally fascinating kind of paper in the Journal of Finance, Private Equity Performance, What Do We Know? What we start to see is that there is actual evidence of outperformance in the private markets. And that could come, like you said, it could come from the engineered risk of leverage, illiquidity, meaning tying your money up. You can't actually get access to your money, or the skill of the manager. And as you kind of dive a little bit further into that, I think we'll hit on this throughout the podcast today, is not all venture, not all private equity is created equal. And we'll start to see that pretty pervasively throughout the evidence. But we start to see that top quartile outperforms far and away above the rest of the field. So, it seems that skill certainly does exist in those private markets. It's just making sure that, right, we're taking the right considerations when we're trying to evaluate them.
Yeah, and then add to that too the persistent nature of it. So what persistence is the continuation, right, of those outsized returns, right? Do we have a confidence that amount, that private equity outperformance that Brandon referenced, is that going to persist into the future? And I mean, obviously we'd say it ad nauseum here, time and time again, we can't truly predict the future, but we're going to really test it and say, okay, are there valid drivers or valid reasons to expect this all to persist in the future? The one thing I would also add, kind of as a caveat to this too, is we also have to think about this from a cost of capital, and this kind of gets into access, right? And we'll talk about this a little bit, where some of these outsized returns that you see or hear about in venture capital and private equity are due to the fact that there were only a limited number of players in the past, and they had, they were the only players. They had the access to the best investments. They had access to the best capital, and therefore their returns, kind of as a result of that, looked fantastic. That's not necessarily true anymore. It does seem to appear that there's still the ability to get excess returns versus the public markets in private equity or venture. However, there's a lot more access out there. There's a lot more products being put together and pitched to retail investors and all that stuff. And that's not necessarily a bad thing. It's important to keep in mind as the investor, okay, well, why am I getting access to this? Why aren't they going to the big institution that would write them a, $200 million check instantaneously, as opposed to a collection of individuals that are going to write, arguably big checks, but small relatively speaking. So it's also really important to keep that in mind, and something we always have in the back of mind as we're doing our diligence on some of these investments.
Yeah, I think that's a really good point. I think things are becoming a lot more accessible. And that certainly does, I think, kind of muddy the waters a little bit. But when we take a step back and you think about access in its true form, like, why am I getting, to your point, Justin, why am I getting access to this, right? If I'm a cloud company, I'm the founder of a cloud company, I'm the founder of the next Zoom, and I want funding, am I going to run down to, the buddy that I have that maybe is in the clubhouse because I know he can round up some money, I can get him excited? Or is it better for my business to go try to pitch Byron Dieter at Bessemer, who created the Cloud 100, who's invested in every successful cloud startup seemingly that we've seen, and know that, hey, if I can convince Byron, now he's on what's called my cap table, he's on my fundraising list, how much easier is it going to be for me to develop contacts, to raise money in the future, et cetera? So, it's not a knock on people. I think it's going to be really interesting. It's just, what do you bring to the table, right? And we hear this time and time again. It's, these big funds, they can turn down the big institutions because, especially in today's environment, capital is not the problem, right? There's plenty of capital flowing around. So it's, what else could you potentially bring to the table to help kind of further things along? And so, I think when we start to evaluate, how do we actually get access to that top 25%? And think about it, if you were that person, accessing those deals, are you equipped to be in that top 25%? I think that's a really good lens to start to look through when you start to see deal flow coming. Because, we hear about it all the time. Everybody thinks they have some special insight into deal flow, but I think you need to be careful out there.
Yeah, and before we even kind of get to that point, right? We have some building block considerations. Okay, what's the merit of this, right? We've somewhat touched on that, where we think, okay, in general, private equity, venture capital has demonstrated some ability to outperform. Okay, that makes sense. Okay, then we say, what's the confidence? Touched on that a little bit. We're going a little bit more in depth on access. Makes sense. We need to ask ourselves the question of liquidity. How long are we willing to tie up money? Does it make sense to say, okay, well, in a downside scenario in some venture capital investments, you're saying, hey, maybe it could be 10 years before I can get all of my money back. And are we comfortable with that? You may or may not be, right? These are all considerations that kind of go into this. Another interesting way to think about it too is there a public market proxy, or is there a public market equivalent that we could implement that gives us a very similar type of return profile? You actually see a lot of academic studies that show, hey, in some cases in the private markets, all you need to do is invest in small cap companies and do it on margin, right? Introduce leverage there, and you're going to get the same type of return stream. And you'd potentially rather do that because the costs are really low and there's no illiquidity, and just, something to keep into consideration. And then one of the things I like to think about quite a bit, and we've been thinking about a lot here lately, is that the portfolio construction aspect of it, right? If you're just being pitched a private investment because it's sexy and it's cool, and there's no consideration on how it folds into your broader portfolio, you're dealing with an amateur, right? You're dealing with somebody who's really trying to sell you a product, in my opinion, and they're trying to just attract you in because, hey, we got this sexy access to this cool investment, and you should put $100,000 into it, or whatever the case may be. Well, that's okay, but it really is not benefiting you, and it's not being done in a way that takes into account your desired outcomes. And we talk about that a ton, right? Where we're going to look at a total portfolio approach when we apply this. If you make a commitment to an investment and it's going to take them 4 years to call all your capital, chances are you're going to be holding that amount in cash to meet that capital call, and there's a huge cash drag on these returns, right? That's something we think about. So we try, the way we can implement is we minimize cash drag and almost, can eliminate it in some cases, because we're really, really thoughtful in folding private investments into a broader total portfolio strategy.
Yeah, one of the things I love listening to you guys talk about here is you're really starting to break down why are people compensated for the risks, which creates the returns in the private markets. And what I wanted to take a step back and look at is just to reorient that we're not saying that all of your money should go into the private markets, right? What we are saying is that if you define success as all I care about is the highest returns, all of the academic evidence says you should be in the top quartile of early stage venture capital, right? Like that produces the highest returns. As you've heard us say so many times on these podcasts, though, your definition of success is, can I achieve the priorities in the life that I want to live? And so the takeaway is not, I should not invest in the public markets. It's that I should have a strategy and understanding of what my priorities are. And if part of that says I have enough money to try to outperform and capture higher returns, the only logical, rational place that I should attempt to do that has any academic evidence behind it is in the private markets. And so we want to protect you against the amateur moves of trying to pick individual stocks inside the public markets, or making the other mistake we see a lot of times is when there's a misunderstanding of where returns come from, people get scared of the public stock market and they start to confuse, well, maybe I want to go invest in private real estate instead of the public stock market, or Bitcoin instead of the public stock market. And you actually are comparing two, an apples to oranges things. The public stock market is a location, an actual place where you can access types of investments. Same thing with the private markets. Real estate, Bitcoin, technology companies are what you invest in, not where you invest. And so I think it's good to just orient us as listeners to understand that it's about the locations, public versus private. It's like a golf course. I can go to a public golf course or I can go to a private golf course. And these barriers start to introduce where some of these returns come from. In a holistic, integrated plan, you most likely should have access to money in both the public and the private markets. And so I just thought that that was an important framework to bring to the forefront of this conversation.
I think, it's a huge point. I mean, make no mistake about it. I don't think there's anybody out there that shouldn't have the vast majority of their assets in the public markets. That is certainly not what we're saying. The only time you should be accessing the private markets is if you could fulfill a few criteria, right? Like you said, Erik, I mean, if your essential priorities are met, probably if your important priorities are met, now we start to look at, okay, if it interests you, if you want to take this chance that you can find some outperformance here, then maybe you introduce the, concept of private markets, but then all those other filtering questions come in. Okay, I want to play in the private markets. Well, shoot, I want to play Major League Baseball. Guess what? I can't hit a slider. We all know that. And that's why I'm here talking now as opposed to actually playing. So, do you have the ability to go play in the major leagues? Do you have the ability to go access the top quartile investors in the venture space? I think that's really the process you have to start to go through. And it's somewhat tongue in cheek, but it's actually a really accurate analogy in my opinion. So, I think you even talk to some of the most successful venture investors out there. I won't name names, but I've had conversations with them. I mean, these are people, hundreds of millions of dollars that have created great wealth in venture. And as soon as they see a lot of these liquidation events, they take that money, they go put it in an index or a structured, kind of dimensional fund advisor portfolio, or they go buy farmland or something like that. But they get it the heck out of the venture space because you don't want to be over concentrated there because it's also the place highest returns, but also the highest possibility you might lose everything.
Yeah, right. It's like it gets back to this idea of total portfolio approach, right? If you're just doing these deals one off, you're concentrating some risk, some sizable risk in your portfolio, right? Another consideration too is how much of the portfolio, assuming your situation checks all these boxes we're talking about, right? Essential spending needs or essential priorities, important priorities. Then the excess capital, okay, how much is that? Of that amount, what's a prudent amount to private markets? You hear anywhere between 10, 20% potentially of your overall portfolio in private markets makes sense. Well, then it also makes sense to say, okay, I'm going to put together a game plan over the next, let's use 5 years for sake of example, that over the next 5 years, I am going to take advantage of private investment opportunities as they come up, as opposed to put it all in the first opportunity that comes your way, which again is concentrated risk. And so do you have the capital to participate in and the portfolio management wherewithal to manage the flows that comes with committing to something over the long term, that 5-year period? And again, at the end of the day, it kind of to Brandon's point that final conclusion is a pretty hard spot to reach, right? Most people don't, in our opinion, have the structure in place and the assets and the wherewithal and the ability to participate over the long term to get that diversification, if you will, throughout private investments. Most individuals don't have that final portfolio.
Yeah, and this has been so helpful, just even having this conversation of there is so much more we can go into depth, right? When we say the private markets, as we reiterate, that's a location. There are tons and tons of different types of investments in the private market. So we could do a whole podcast, which we'll do in the future, on real estate. Within real estate, right, we could break that down from multifamily to commercial to residential. Then you could take the conversation over to private equity. What type of companies are we taking? Public companies and moving them private? Are we now talking about cryptocurrency? Are we talking about early stage startups? And so, when we talk about the private markets, is you have to have the right access, right? Same thing on the public markets is you have to have the allocation in the proper way, globally diversified, low cost, tax efficient. And so we hope that this has been a helpful start to the conversation around this. And I just want to reorient, right? You guys that are listening, guys and gals, you are the best in the world at what you do. And something we're so passionate about here is, what does it take to be a professional? And apply what it takes to be a professional in your given industry and craft. It's not shooting from the hip, right? It's not taking flyers one off in the amateur space. There is a process, there is evidence, and there's academic research that says this is what's going to lead to elite outcomes. This is what the professionals do. And we're, here to help you avoid the mistakes of the amateur. And I think that that's what we are so scared of. What we've seen over the past year is that when the markets move up higher quickly, you can literally throw a dart against the dartboard and have some success, but the risk comes when the tide goes back out, right? And so that's why this conversation is so important to us, is you guys have worked so incredibly hard for your money that if you are going to introduce risk in your guys' portfolios and risk your priorities, we just want to make sure you're getting compensated with the returns that you deserve. And hopefully the takeaway here is, have a plan in place. Make sure you're meeting with your certified private wealth advisor, that your CFA is the one that's directing the type of investments that are going into your portfolio. And so once again, we'll make sure to link in the show notes to a few of those research things, papers that Brandon mentioned, some other resources that Justin's mentioned. You can grab that over at awminsights.com. And until next time, stay humble, stay hungry, and always be a pro. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.